What happens when inflation falls during a deep and prolonged recession? This question, although seemingly straightforward, opens up a Pandora's box of economic complexities. Imagine, if you will, our current economic situation. We're living in a world where panelists believe that inflation could take a nosedive if we were to experience a long, drawn-out recession. But there's a twist in the tale. There exists a possibility that our economy could slip into a state of stagflation. This is a scenario where high inflation coexists with economic stagnation. Lance Roberts, an economic analyst, argues that we must consider this potential state of affairs. Now let's throw another spanner in the works. There are concerns about the accuracy of labor market data. In particular, eyebrows are being raised over the Bureau of Labor Statistics' birth-death model. This model, which estimates business openings and closings during a recession, is often accused of painting an inaccurate picture. Furthermore, it's not uncommon to see frequent revisions of this data after its initial release. But wait, there's more. The US budget deficit, currently running at a staggering $2 trillion per year, is viewed as unsustainable. This deficit could, in fact, slow down any potential recovery. Despite the Trump administration's stimulus policies drawing comparisons to the Reagan era, the current situation is distinct. The public debt to GDP ratio is a whopping 130%, a far cry from the 30% of the 1980s. In the midst of these potential problems, there are also investment market trends to consider. On one hand, there are opportunities to buy stocks in sectors that are under immense pressure, like energy. Despite falling prices, these sectors have solid fundamentals. On the other hand, hard assets like gold, zinc, uranium, and natural gas stand out as potential hedges against inflation and currency depreciation. The recommended investment strategy is to use the dollar-cost averaging method in undervalued assets, particularly ETFs. This spreads risks and encourages caution when investing in individual stocks that carry high risk. Let's not forget the role of the economic cycle. It's emphasized that the business cycle is an unavoidable part of economic life. Efforts to prolong this cycle may actually exacerbate the problem when it eventually occurs. Lastly, there's a political economic view to consider. Trump's trade policies, such as tax increases, have led to a temporary increase in inventory. This could, in turn, affect short-term economic data. In summary, the key takeaways are these. Be prepared for economic recession risks by investing carefully in assets with strong fundamentals and those that are undervalued. Be ready to question official economic data and keep a watchful eye on fiscal policies that affect long-term economic stability. As we navigate the turbulent waters of the economy, these guiding principles will serve as our compass, leading us towards a more secure financial future.